8 figures in assets, but the bank just said no to your $3 million mortgage. They used an outdated credit score and completely ignored your liquidity. In the next 9 minutes, I'll show you the exact 15 to 45 day playbook that gets wealthy borrowers approved without liquidating your portfolio or torching your investment strategy. Here's what just happened to you and why most wealthy borrowers never see it coming. The lender pulled a classic FICO mortgage score that's different from every credit app you ever checked. They applied jumbo overlays requiring 12 months of reserves you didn't know about. And here's the kicker. You weren't denied for being poor, you were denied for being complex. Your authorized use your cards, your business credit utilization, your investment income structure, it all works against you in ways nobody explains. I'm about to expose the 3 psychological traps banks use to reject high net worth borrowers, reveal the 48-hour counterattack that forces their hand, and show you the private banking playbook that bypasses this entire mess. But first, the bomb I'm about to drop will change how you think about mortgage underwriting forever. Look, if you're watching this, you're probably worth 5 to 50 million or maybe less, maybe more. You've got investment portfolios, real estate holdings, business interests. You're used to getting what you want when you call the bank. So when some 25-year-old loan processor rejects your mortgage application, it feels personal. It's not personal, it's systemic. And in exactly 60 seconds, I'm going to show you the precise moment where most wealthy borrowers' applications fall apart. And it has nothing to do with your net worth. Here's the trap. Your iPhone says 780, Credit Karma says 785, but the lender just pulled a FICO Classic 4 that came back at 698. Same person, same day, different universe. The FHFA is still transitioning to newer models, but most conforming lenders use the old school version. Your authorized user cards that boost your app scores, they either don't count or actually hurt you with mortgage underwriters. And here's the part that'll make your blood boil. Those reserve requirements nobody mentioned, jumbo lenders want 6 to 12 months of mortgage payments sitting in cash, even if you've got 20 million in Tesla stock. Ready for the bomb that I promised? Here's what actually happened. Forget about crying about it. Here's your counterattack and your starting day. Step 1, demand your adverse action notice. Not some vague, insufficient credit history bullshit. The specific score they used, the key factors, the exact reasons. Step 2, find out which credit model they pulled. Tri-merge vendor, FICO version, everything. You can't fix what you can't see. Step 3, lock your shopping window. You've got 45 days where multiple mortgage inquiries count as just one hit on your credit. Use it strategically. Step 4, escalate to private banking. If you've got 3 million in assets under management, you qualify for a relationship underwriting that plays by different rules entirely. But here's what nobody tells you about why this happened in the first place. Reason number 1, authorized user pollution. You added your kid to your Amex thinking it would help their credit. Plot twist, mortgage underwriters either ignore AU accounts completely or worse. They count the payments against your debt-to-income ratio. Unless you can prove you've been making those payments for 12 months, they're worthless. And if you just added them, they can actually disqualify you from automated approval systems. Here's reason number 2, active disputes. You disputed that one late payment from 2019 thinking it would help your score? Wrong move. Active disputes can trigger manual underwriting or outright rejection from automated systems. The computer sees the dispute in progress and it says too risky, fine. Meanwhile, your $10 million net worth means nothing to the algorithm. Reason number 3, utilization timing. You've got a $100,000 credit limit, but you put $50,000 on a card for a business expense 3 days before they pulled your credit. Ouch. Boom, 50% utilization, automatic decline. Your accountant says, use the rewards points, paid off the next month. The mortgage algorithm says, high risk borrower, denied. Reason number 4, income complexity. You're a successful entrepreneur pulling $2 million a year through pay-1s, write-offs, and asset appreciation. But mortgage computers are designed for W-2 wage slaves, making $75,000 at Walmart. They're not bagging groceries, by the way. Your sophisticated tax strategy that saves you millions, it looks like income instability to a computer program written in 1995. Remember, reason number 5, reserve overlays that nobody explains up front. Phase A, evidence and leverage. Days 1 through 3, get the exact tri-merge data the lender saw. Map every key factor from your adverse action notice to specific things. Order credit supplements. Cue rapid rescore for verified changes. Targeting 720, minimum 740 preferred. Phase B, profile optimization. Days 3 through 10, Pay utilization down under 9% aggregate, under 6% on your primary card, 0% on everything else. Remove any authorized users that aren't helping, or document 12 months of you paying them. Resolve or withdraw any disputes that block automated findings. Phase C, underwriting lane choice. Days 7 through 21, if you're conforming eligible, rerun through automated systems. If not, use advanced options, such as private banking relationship underwriting, asset depletion programs, or securities-backed credit lines. Each has different timelines and requirements. Contact us for those. Under the Equal Credit Opportunity Act Regulation B, within 30 days of your completed application, the creditor must give you specific reasons for adverse action. Not vague boilerplate, specific. Under the Fair Credit Reporting Act, if they used a credit score, they must disclose the exact score and up to 4 key factors affecting it. 5 factors if inquiries are involved. Dispute timelines. Credit reporting agencies have 30 days to complete investigations. Use this tactically. Most borrowers give up when they should be demanding compliance. Don't be most borrowers. Reserves math. Cash and marketable securities count towards reserves, but they're haircut-based volatility. Stocks and mutual funds typically get a 30% haircut. Pledged asset lending lets you access liquidity without triggering tax events. Understanding the risks. Relationship pricing ties rate discounts to your total balances and AUM. The key is structuring everything to preserve your investment thesis while meeting mortgage requirements. Here's some case studies right here. So, can I just add an authorized user trade line? No, it can backfire. Can we close next week? Possible, but depends on documentation and lender speed. So what if my broker won't do a rescore? Work with the right lender. Is a securities back line a silent second? No. Disclose it. Undisclosed seconds are illegal. Days 0 through 2, get your adverse action notice and tri-merge file. Choose lender path. Days 2 through 7, execute paydowns, AU cleanup, supplements, and rescore. Days 7 through 21, repull credit, lock best offer, prep reserves. Day 21 through 45, final underwriting and close. The key is parallel processing and sequencing. That's how you compress 6 months into 15 to 45 days. On your adverse action notice, the score listed is the one they actually use. Each factor maps to a fix. A rapid rescore can add 40 points in just 5 business days if done right. Documentation is everything. So build an audit trail. By the way, this isn't legal or financial advice. Follow the ECOA and FCRA processes. Disclose all liabilities, understand securities-based lending risks, and last but not least, work with qualified professionals. If you were denied on a $1 to $10 million mortgage and have significant assets, book the path to a clear close session. We triage your adverse action notice, run lender simulations, and give you a documented fix plan. This isn't for everyone, by the way. If your mortgage is $200,000, just work with your local broker, not us. But if you're playing at this level, outcomes depend on file complexity and execution. Our goal is compressing the time to approval by sequencing the right levers in the right order. Sometimes that's 15 days, sometimes it's 45, but always faster than a 6-month nightmare most people endure. Your wealth gives you options. Make sure you're using them.